Hey guys, and welcome back to another video on the channel. If it's your first time here, my name is Brandon. As always, we do have our Investing Academy. If you're looking for some courses and training for beginners, if you're here in Canada, that'll be that first link down below. But in today's video, we have our next episode of 2 stocks to buy right now. This is our newish series where we highlight a Canadian stock as well as a US stock, and we're going to be starting off with the Canadian one. I know the markets in general, it's been a crazy little comeback here. Probably not what a lot of us expected. Markets have really rebounded strong, and in general, I'm not doing a lot of buying. However, I did actually add the second stock that we're going to talk about today. I do think the first stock as well could be a very, very good option if you're looking for some Canadian stocks. We'll dive right on into things. If you enjoy, by the way, give this a thumbs up. But the first stock that we're covering today is the company MoreGuard Corp. The ticker that you'd be looking at here is MRC.TO, and this is a real estate company that is based over in Toronto. And one thing that you'll know if you have been keeping up with the markets and kind of monitoring the different areas is that real estate, this sector has really been impacted by the COVID situation. I'll pop up on the screen here an ETF that I follow, and it's the Vanguard Canadian REIT ETF, a bundle of Canadian REITs. Despite the broader market picking up and bouncing back, this one is down about 35%. And on a side note, if you don't like MoreGuard, the stock that we're talking about today, because it is a smaller company, I think that VRE could be a very, very cool one to look into. Kind of play the field on the real estate market, or the real estate investment trust market, I should say. I know a lot of people have interest in that, and with VRE, you are pulling in a really nice dividend relative to MoreGuard. MoreGuard stock is down about 44% as well, actually a little bit more than the broader REIT market, and that's because it is a smaller cap company. I kind of want to clear that up right off the bat. If you look at the market cap, we are looking at about a $1.3 billion market cap. This is definitely smaller than the stocks we typically cover. Due to the nature of a small cap stock, you can typically expect to see a little more volatility, so bigger swings. And there's actually a term you'll come across called beta, which is how much a stock moves relative to the broader market. This is a prime example how MoreGuard is actually down more than the index here. And if we actually compare the REIT, so MoreGuard REIT, you'll actually see a very big difference here. The same would go on the upside. If things do rebound and if things do pick up, you should expect a nice little rebound. And that's actually why I kind of included it in today's video. If you're not familiar with the company in general, again, they are based out of Toronto. They have a portfolio size, total assets they're managing of $20.1 billion. So definitely got some size to them. They own over 207 different properties all across North America. Primarily, we're looking in Canada here. You'll notice Ontario is kind of their main market. They do have exposure to the US, but like many REITs, you got your mix of residential, retail, office buildings, industrial. These guys even do hotel properties, so they own the hotel buildings. Retail and residential do make up their 2 biggest components though. And just from a very top-down broad level, the company was actually doing quite well prior to the whole COVID situation. If you look at the share price, it has been a very strong company. It's been one that I've just been monitoring going on a few years now. Again, I'm not a huge fan of real estate myself, so I haven't ever jumped in, but a very, very steady performer. In their recent reports, they were seeing growth across all components. The point I'm trying to get across is that when the economy has been functioning well, this is a very, very strong company to own. And now that the stock has seen a pretty steep drop, this is not one to overlook, and it doesn't see drops all too often. I'm just thinking whether this is a good time to kind of take advantage of this real estate weakness if you are looking at it from a long-term perspective. And there's no question, there's no doubt that any company that manages real estate right now, this is going for any recession, but especially a time like COVID, they're going to see tenants struggle to pay rent. They're going to see maybe some tenants, not maybe, there will very likely be tenants that go bankrupt, which is a short-term hit on the company. Very tough across the board, which is why we're seeing this weakness. But from a very base level, if you do believe in the real estate, the property management sector long term, or industry, I should say, I think the share price here may be one to take a little bit of a speculation on. And again, being a smaller company, I would consider this more of a higher risk play. And there are, without a doubt, safer options to rely on. Take a company like Brookfield. If you want to play this space, you can even look at VRE, the ETF that we just talked about. If you do really want to spread your investments out and kind of take a bundle look at things. But if you are looking for a stock that does have some very strong upside, a stock that could see some very, very strong capital appreciation, you're really aiming for that growth, I think at these levels, MoreGuard is one to look into, more or less playing the broader weakness on the real estate market. And it's really as simple as that. The stock itself trades for $118 Canadian. It does pay the 0.5% dividend, quite small. Again, you can look into the REIT if you do want to look for some more income. But MoreGuard is our first stock, our Canadian stock of the two stocks to buy right now. Moving along into our second stock, which does go south of the border. This is our American one. And this is a stock that I did add to my portfolio literally this morning. As of filming it, it is the company Raytheon Technologies. The ticker that you'd be looking at here is RTX. And this is, of course, a company, we've covered them on the channel, not under the name Raytheon. This goes back to when they were United Technologies, but this is a big, big player in aerospace, defense company, airplanes, commercial airplanes. Raytheon Technologies, if you are new, just a little background here. This was a merger between United Technologies and Raytheon that actually just took place. Of course, we also had United Technologies that recently split up. They had a spin-off of their two different divisions, or three different divisions, I should say. But what we're looking at today is a company strictly involved with aerospace. So actually, there are four main divisions now. After everything, there's Pratt & Whitney, which was priorly part of United Technologies. This is the commercial airplane engines. Collins Aerospace. They have a segment for their Raytheon Intelligence and Space, it's called, I believe. And then Raytheon Missiles. So actually defense here. And I know a very high area of interest right now in the market is the airline sector, whether that be through a company like Air Canada or, United, Southwest. Boeing is a way to play that. And we're just getting a lot of questions on these types of stocks. I personally really like the way Raytheon is positioned to get exposure to this space. Because one thing about the company is, if you look at the breakdown, of course they're involved in commercial, but that's not the biggest component of their business. In fact, the defense side of things. So defense, actually, if you include the military in there as well, over half of the company's sales, a very large component of it, is shifted over to this segment of things. And without a doubt, the commercial side of their business will take a hit. I think that's pretty known across the board. But the defense, the military side of things does provide a lot of stability. And even, I feel like I'm rambling on here, but even on the commercial side of things, one thing that I really like about a company like Raytheon or United Technologies is the way they're structured, the aftermarket services. So essentially, if you put in a plane, if you install a jet engine or whatnot, these huge pieces of machinery require ongoing maintenance. And the fact that you can lock yourself into a contract here for 5, 10, 15, 25 years going forward, that provides a lot of recurring revenue for the company. So they're involved in the aerospace or airplane division, but the way that they're structured kind of sets them back a little bit. And they're not as impacted as a company, like I said, like Air Canada or a Boeing even. I actually look at this from time to time. Sometimes these institutional transactions, I got a list here of big institutional companies, hedge funds, large money managers. We see a lot of activity in Q1 here of institutions buying up this stock, either opening new positions, increasing their positions. Of course, we do see here Neuberger Berman. They decreased their position by 48%. And not to just say that if institutions are buying a stock, that means it's automatically good. But it can definitely complement your investing thesis, kind of the way you view a stock. So very, very positive to see, in my opinion, there. United Technologies was a company I followed much closer, but this has been one of my favorite companies in general when it came to the stock market. I've always been a fan of their aerospace division. If you'll note, you got a PE of 13, which is below its 5-year average, which is something that we love to see as a buyer. Stock has been down pretty significantly. I'm actually down on my position. So I was actually down a decent amount, and again, long-term outlook, I do have a lot of confidence in this company. So I went in, actually doubled down on my position. I know the Canadian dollar is not the best right now for our Canadian viewers, and a lot of people are avoiding the US stocks, but with a stock like Raytheon, I thought this was a really good opportunity despite that, and I actually went in and added it to my portfolio. So that's our second American stock for the video. It trades for $63 USD. It does pay the 3% dividend, which is super nice to pull in at levels like this. But those are my two stocks for the video, guys. Two stocks to buy right now, one Canadian, one US. Let me know what you think of my picks. Do you like them? Do you not like them? Went for more of kind of like a top-down quick view, like a quick hitter video today. I'd love to hear your opinions on that. Feel free to leave them down below. And if you enjoyed, don't hesitate to drop a quick thumbs up. That is just an awesome way of showing your support on the channel. And I really, really do appreciate it. If you're new to the channel, subscribe. We post videos like this every week, and actually thinking of posting this video a little bit more frequently, just showcasing a couple stocks that I'm really liking. As always, we do have our Investing Academy. If you are a beginner here in Canada and you do want help getting set up, joining our community, we're basically guiding people through that entire process. And you can learn more about that by clicking the link down in the description below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next